Moving averages. Now, technical analysis focuses on market action, specifically volume and price, and it is just one approach to analyzing stocks. Moving averages are one of the core indicators in technical analysis. Therefore, an understanding of this is extremely essential. Now, the most common applications of moving averages are to identify the trend direction, and it can also be used to determine support and resistance levels. I will explain that with an example, but for now, just understand that moving averages are primarily used to identify the trend and to determine the support and resistance levels. Now, what this does is the moving average will simplify the price data by smoothing it out and creating one flowing line. So, this typically takes off the noise in the stock data. So, that way you can see the trend easier. There are two types of moving averages. One is a simple moving average, SMA, and the other is the exponential moving average, which is the EMA. Now, simple moving average, as it implies, it is just the mean or the average of the stock price values over the specified period of time. Now, this period of time could be on a daily basis or on a weekly basis, or even if the trader is looking to understand moving averages for every minute, so he can look at the moving averages for minutes. So this period really depends on the trader. For example, the 5-day simple moving average will add up the 5 most recent daily closing prices, and then it will divide by 5 to create the new average each day. So each average will then be connected to the next, and then this will create that singular flowing line that I mentioned earlier. Now, the calculation for the exponential moving average is a little more complex as it applies more weighting to the most recent prices. So again, charting softwares and trading platforms will do the calculations for you, so there is no manual math required to use this moving average. Now, as a general guideline, if the stock price is going to close above the moving average, then the trend is typically up. So the stock is in an uptrend. Now, if the stock price is going to close below the moving average, then the trend is down. So the stock is trending down. And also keep in mind that exponential moving averages will react quicker to price changes than simple moving averages. So this is just a theoretical explanation for what moving averages are, why we use them. But in the next video, I will show you an example. We will just pull up a stock chart of a company, and then we'll go over some of this. Thank you. My favorite ticker sign is Google. I always trade this. So let's take a look at the stock chart for Google to explain the moving averages. So the problem with free version is you get these ads, you have to close them. So here I am on stockcharts.com, and I pulled up the stock chart for Google, and I'm looking at the daily stock chart. Right? Let's not worry about anything. Let's not worry about the candlesticks or anything. Let's just look at these lines here. So the blue line shows the 50-day simple moving average for Google, and then the red line shows the 200-day moving average, simple moving average for Google. Again, you can add other lengths on this chart too. So let's say if you want to add the 10-day simple moving average, you would just go down here, and I'm going to say 10 days simple moving average for Google is going to be added onto this chart. So like I said, you don't need to know how to calculate this. The charting platform is going to do that for you. So again, just by looking at this, you can see that the moving average with a shorter time frame, in this case the moving average for the 10-day period, is reacting much quicker to price changes than the moving average with the longer periods. So either the 50-day or the 200-day. So again, there are a couple of things you can do. If you're a short-term trader, you can focus on the 10-day or even the 15-day moving average. And if you're a long-term trader, you can focus on the 200-day average. Now the moving average is also helpful so that you can you can see the direction of this moving average to get a sense of which way the price is moving. So for Google, clearly, well, it is trending up. You can see that the price is moving up because the moving averages are angled up. So if I were to pull up a chart for some other company where you see the moving averages are angling down, it means that the prices are down overall. And if it's moving sideways or choppy, so the price could likely be in a range. So I also mentioned in the previous video that the moving average can act as a support or a resistance. So Google here is in an uptrend, so we would just look at support. So the 50-day moving average or even the 200-day moving average could act as the support level. So what I mean by that support level is that this average is acting as a floor or a support so that the price is bouncing up off of it. So see, so in this case, the 50-day moving average, at some instances, it is acting as a support. So the stock did not reach down, it is bouncing off of that level. But in this case, it breached, it went down, but it's testing the 200-day moving average, but then it bounced again. So we could use, so here it came again, it slightly tested the 50-day moving average, it bounced below, but then it quickly bounced back up. So you can use the 50-day and the 200-day moving average to see as a support. Now again, if the stock were to be in a downtrend, this moving average may act as a resistance. So like a ceiling, the price hits the level and then starts to drop again. So as you saw here, the price will not always respect the moving average in this way, right? So it may run through it slightly or it could stop and reverse prior to reaching it. Earlier, I also said that the exponential moving average reacts quicker to price changes than do simple moving averages. So let's take a look at this in the chart. All I'm going to do is I'm going to take a look at the simple moving average for 50 days and the exponential moving average for 50 days. Oh my god, what's going on? Dictionary, no, I didn't do that. Today I don't need this. Let's compare and see what's going on. So on the same chart, I have the exponential moving average. I don't think it worked. Hang on. Not the 20. Sorry. Free version. You'll have all these ads. Okay. Great. Looking at the simple moving average for 50 days and exponential moving average for 50 days, and compare this. So the blue line shows the simple moving average for 50 days, red line shows the exponential moving average for 50 days. So what can we observe from this? So you can clearly notice that the EMA is reacting more quickly to price changes than the SMA. This is again due to the additional weighting on the recent price data. So things to note here, moving averages are calculated based on historical data and nothing about the calculation is predictive in nature. So therefore, results using moving averages can be random. So these work quite well in strong trending conditions, but poorly in choppy or ranging conditions. So in this case, Google is on a very good uptrend. It's trending, so we could rely on some of these indicators while trading. Again, one type of moving average isn't necessarily better than others, so sometimes the exponential moving averages may work better for a stock for a time, and at other times the simple moving average may work better. So again, the time frame chosen for a moving average will also play a significant role in how effective it is, regardless of the type that you use. So I guess this should give you folks a clear understanding of how to look at the moving averages on a chart. And in the subsequent videos, we'll talk about some of those other indicators. Thank you. Here is another example of a stock chart just to show you that the moving averages are trending downward. So in the previous video, we talked about a case where the moving averages were trending up. In this case, I just wanted to show you an example of a stock that is trending downward when you look at the moving averages. So I pulled up this company called Viemed Healthcare, which trades on the Toronto Stock Exchange. And if you look at the moving averages here, the 50-day moving average is clearly trending down. But if you look at the longer term moving average, which is the 200-day moving average, it tells another story because it is still trending up. Now, in this case, the 50-day moving average was tested and the stock broke down. So it initially did act as a support, but once it broke down, the stock was trying to test the 200-day moving averages, right? So in this case, the 50-day moving average ended up being a resistance because, so if you look at this, it tried to go up, but it came back down. So this was the resistance here. It tried to go up, came back down. It tried to go up, it came back down. You can also look on the other side because the 200-day moving, so in this case, the 200-day moving average is trying to act as a support. The 50-day moving average is trying to act as the resistance. So this was the ceiling. It tried to break out, but it came down. It tried to act as a support. It bounced. The 200-day moving average is acting as a support. In this case, it broke through for a bit, but then it came back down. And then the 200-day moving average is also broken down to the downside, and it started going down. Now, technical analysts also use, so here's an interesting thing that you can see. So the short-term moving average, the 50-day moving average, crossed the long-term moving average, which is the 200-day moving average, to the downside. So typically, I think they call this as the death cross. So what this means is that the stock has reversed the trend, meaning the uptrend is broken and the stock is starting to trend downwards. So this could potentially, all the traders would start using bearish strategies to go short on this stock. So, but again, I don't want to talk about strategies just yet. I just wanted to use this example to show you, how the moving averages can trend down and how it was being used as a resistance, adding on to the previous example that I talked about in the previous video. Thank you.